Okay, let's get started. Welcome everybody to the Quest Resource Holdings Business Breakdowns. Before we get started, I just want to remind all participants the purpose of this presentation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. MicroCapClub is not a registered investment advisor. MicroCapClub, its partners, members, subscribers, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security. I want to thank the MicroCapClub community for tuning into this business breakdowns conversation with Ray Hatch, the president and CEO of Quest Resource Holdings. My tag team partners for this business breakdowns are Greg Kitt and Jordan Salim. I believe Jordan is just on listening only mode, but Greg and Jordan come from Pinnacle Family Office, where Greg is a general partner and Jordan is an analyst. Jordan has been a MicroCapClub member since 2020 and Greg since 2022. If you're interested in learning more about Jordan or Greg, we'll put a link in the show notes to an interview with Jordan and a link to his work. And guys, it's an honor to have you on the business breakdowns. Welcome.
Thank you, Adam. Appreciate it. And Brett Johnson, our CFO, is on as well for the presentation. So
great. Yeah, my apologies. Brett Johnson, CFO, is also with us from Quest. The business we're breaking down today, obviously, is Quest Resource Holdings, which trades on the NASDAQ under the symbol QRHC. QRHC was originally profiled in 2017 by PDS Financier. Quest Resource Holding is an asset-light waste and recycling services provider, benefiting from increased interest to divert waste away from the landfill because of external regulatory drivers and internal ESG mandates. Quest boasts long-standing relationships with a diversified base of blue-chip customers and provides data and reporting to customers to meet internal ESG and regulatory requirements. Quest diverts 80% of waste away from the landfill by recovering the salvage value for these commodities, meaning customers benefit from increased landfill diversion, reduced operational complexity, and modest cost savings. Quest's waste hauler partners gain access to large volume waste generator customers and that they could not otherwise win. These waste haulers benefit from high margin incremental volume and offer Quest attractive pricing in exchange for these large dependable customers. It has been noted that Quest's business has true flywheel effects, where Quest's unit economics improve with scale because Quest can effectively reduce service costs to its customers, which drives incremental business, creating the flywheel. Scale drives network effects that improve Quest's value prop to its customers and haulers. And Ray spoke up a minute ago, Ray Hatch. Ray, thanks for joining us today.
No, thanks, Sam. We appreciate you having us. We love talking about the company, so thanks for the opportunity.
Absolutely. Before we get into your presentation, it looks like, Ray, you've spent time in both the food distribution and waste management spaces before leading the charge at QRHC. I'd love for you to maybe just talk briefly about your background and maybe similarities between the two industries.
Yeah, I appreciate that. Yeah, I spent most of my career, the vast majority of it actually, until probably about 10 or 12 years ago in the food distribution business, all the standard players, Cisco, US Foods, those guys. And that's all I did out of college. So that's all I knew. But it's really not about food. It's not about what you're selling. It's about who you're selling to and what they need. So I've always been in the B2B environment. And so as strange as it sounds, the transition really wasn't difficult to move from selling restaurants and resorts, food service operations, their food products to resell, to selling services that have hopefully a positive impact on the same businesses and others in the waste side. So we still deal with large national accounts, large brand names. We solve problems for them. And Quest happens to do it in the waste and recycling space. That's the area we operate in.
Excellent. Thank you for that color. Great. Well, now let's go through the presentation. As a reminder to the audience, if you have any questions, you can ask by clicking the Q&A button at the bottom of the Zoom screen and entering them there. And after the presentation, we'll get to as many questions as we can. So Ray, the floor is yours.
Thanks, Adam. I really appreciate it. And again, Brett and I are really appreciative of the opportunity to speak to your group and tell the stories. And we encourage any good questions that can help us highlight the company better. So again, I think Adam mentioned Quest. We're Brett. Why don't you go ahead and skip to page 3? I guess the second one. Always skip the Clean Harbor stuff. Um, we're based here in Dallas, Texas. Market cap around 164. So I think our TTM is 286 million. Analysts have us a little over 300 for fiscal 24. We help. So let's talk about what we do. We help customers solve problems, and most of it's around the waste and recycling. There's nobody that this is the stuff that goes out the back doors of businesses, and it's a necessary evil that needs to be dealt with, and we try to handle it as such so our customers don't have to deal with it. So the type of materials we talk about, well, before I do that, we do deal with over 100 plus waste streams, well over 100 waste streams. It's amazing how many different ones there are. When I came into this business, I knew nothing about the waste and recycling space. And it just blows my mind how complicated and how intricate it can be as to the type of materials you're transporting and dealing with. We have a nationwide footprint. So the important aspect is what we can do is we can handle pretty much any type of waste generated by any business in every zip code in the US, which puts us in pretty rarefied air. There's not many people that can do that. And our business model that we'll talk about more allows us to do that more effectively. The type of materials we handle, and this is just a snapshot, like in the general recyclable place, we all know cardboards, recycles, metals, cardboard, recycled metal pallets, wood, all the generic stuff. But one of the things that separates us from our competitors is we also do automotive waste. Used motor oil is a big commodity for us that we deal with. Oily water, antifreeze, brake fluids, airbags, paint waste, you name it. There's a whole lot of solvents. All of those have got regulatory issues associated with them, which is something else that we bring to the table from a solution perspective. Food waste is an extremely growing category. We've got a lot of momentum behind that. And the food waste is pretty much all organic material. It includes used cooking oil, but mostly it's fruits, vegetables, meats, seafoods, those type of things. But all organic material is considered food waste in this category. The regulated waste, which ties a little to the automotive stuff, is the combustibles, the corrosives, e-waste, light bulbs, batteries. These are all things that require different solutions. They're not simple. You just don't throw them in the landfill. So you need a company that brings you a solution if this is the kind of waste you generate. And then on the construction side, we do, that's a real opportunity for growth in good times, concrete, drywall. When you see those big open top containers outside large construction sites, a lot of times that's us. And we help them to divert also different materials to the right places. So let's go to the next one, Brad. So that we talked a little bit about, what we do, materials. So let's talk a little about who we do it for. I referenced B2B. Well, it's not only B2B, we're kind of B2B with a Fortune 500 focus or Fortune 1000 focus. The more locations a customer has, the more complex their waste streams are, the more value we bring to them. So I wanted to show this slide because it's not just the names of the companies on there, but the two takeaways I want you to get are our customers are large national brands. I'm sure you recognize the vast majority, if not all of them. These are just a handful of our brands, by the way. We do a lot more than this. But I want you to understand the strength of the customers we deal with. They're tremendous. And also the diversity of the end markets they operate in, from AT&T to Sonic. I mean, you got food, you got fleet, you got building maintenance, you got retail, you got auto dealers, contract feeders. I'm just kind of looking through this thing. Large grocers and fleets and more. So the reason that's really important is, I believe, the diversified end markets we serve, and we pretty much do all of them. It's hard for one economic tsunami to wipe them all out. So like, for example, during COVID, we didn't know what to expect. I was scared to death. I'm sure a lot of you were too. So we battened down the hatches. And what happened was, not surprisingly, automotive suffered pretty bad. Nobody was driving cars. You remember that? The roads were empty. So nobody's having their oil changed and nobody's buying new tires and filters. So that business really got hit hard. But at the same time, grocers, multifamily apartment complexes, they went up, so we really had a nice, we negated a lot of our risk with the diversity of the type of customers we serve. So that's an important part there. Let's go next, Brett. The business transformation. So there's a bit of a history here. And I guess selfishly, we started this when I came to work here at 16. So maybe we'll pretend like the rest of it didn't work. But we started in 16 trying to transform this business. The business, and one of the reasons I took the role, the business had a really nice brand, has a really nice brand, and a lot of nice customers, but didn't know how to make money. Margins were obscenely low, gross margins. There weren't any net margins. We had a lot of SG&A associated with accounts that were generating a lot of revenue, but really minimal gross profit. So that's a formula for disaster. And we didn't have any cash, and the bank wouldn't return our calls. Other than that, everything was great. So we've generated a 40% CAGR in rev over the last several years, 20% in GP dollars since inception. Our gross margins were probably in the, I'm trying to think, maybe 8-9%, something like that. Not even that, less than that. And we grew it up into the 17, 18, 19, where we are today. And we actually have an EBITDA margin today. But the transition, we'll talk about what happened was we cut our revenue. I'll just give you the synopsis. Our revenue is probably $180 million run rate at that time. But we were losing a fortune, had low GP dollars. We ended up cutting our revenue pretty close to half, moving away from business that wasn't contributing on the profit side. And that took a lot of effort from the team to do that. But we walked away from a lot while we were buying time to be able to implement new strategies relative to who we sell and what we sell, who we sell to and what we sell, to be able to take our margins north. And so we got EBITDA positive there in a couple of years, and then kind of grew from there. We started our M&A process in the end of 20. We bought a handful of companies through the next 12 months. And then we've now started our organic growth back again after we've gone through that shakeout phase. So we kind of have the three-legged stool working pretty well for us now, which is expansion with existing clients, bringing on new brands, and then also opportunistic M&A. So go ahead, Brett, if you would. The key problems that we solve. Sustainability, we've really had good timing as far as our positioning at a company. I love the space we're in right now relative to market growth opportunities. You all know what sustainability is, but 10 years ago, I doubt you did. I didn't, or 15 years ago. It wasn't a term that was used or cared about, but it continues to gain momentum. Companies are continuing to try to find ways to be more sustainable, and we exist to be able to help them do that. The landfill costs continue to increase. Those of you that listen to our competitors' calls, the big guys that are public, they constantly talk about margin improvement, and the way they improve margin is to raise costs in landfills and tipping fees. That's it. I mean, it's just continuing to raise costs, and it creates more opportunity for us in that regard. City, state, and local regulation. Contrary to popular belief, at least my experience over the last decade, is the feds really don't have a lot of impact on this. There's a lot of talk. There's a lot of political talk about saving the environment from the federal level, but the people that really do it or don't do it is at the state level, and even more so at the municipality level. And most of that regulation that I'm referring to that impacts us is restrictions around landfills. What can you throw away? How much can you throw away? And if you're restricted from a landfill, you have to find a place to send your waste. And a lot of times people don't know where that is, and that's where we come in. We're the who you're going to call folks when you have some regulation come down that tells you you can no longer throw this organic material above a certain number of tons in your compactor and go to the landfill. So that's where we can help. We divert that. Another thing that's really it's fragmented across numerous geographies, the service providers. Most of these large companies and a lot of those brands I showed you earlier and more, they centralize so many things. They centralize, if you're a food chain, you don't decide if you're managing that, if you're going to use a different kind of bun or a different kind of hamburger patty or a different kind of whatever. It's all decided by corporate. The one exception seems to be waste. Over the years, they've left that decentralized and decision makers at typically local levels. Well, that promotes problems when now as a company, you're being held to sustainability standards. Your investors are asking about the number of tons you're throwing away, where it's going. If it's all, there's a couple problems. If it's decentralized and done locally or regionally, you have no control over that. Second, you also don't get to leverage your national scale with providers if it's all being done on the waste side, if it's all being done decentralized. We do leverage that scale across all the zip codes, all the providers. So we're able to bring cost effectiveness, visibility, and accountability relative to sustainable practices. And we're able to centralize it, and we do it. So you're able to, you as the customer or prospect, are able to have those resources you have focused on what's really important, is making better widgets or whatever it is you happen to do. The E in the ESG is what we affect, environmental, not societal or governance, but the E is the big one. And regardless of your desire as a company to be more sustainable and to take care of the environment, unless you can actually track it with data that's verifiable, you really have an initiative that has no teeth to it at all. So we're able to, every time we touch a piece of material and we pick it up, we're able to report what the material was, when it was picked up, how much of it there was, and where it's going. And so from that, you're able to hold your locations accountable to a corporate plan. And we really have found a nice niche enabling large corporations to be able to basically do what they want to do and help them execute against it. So let's go to the next one, Brad. So the national solutions that address full waste and recycling needs for large businesses. That's basically it. If you look at the platform here on the client side, we've talked about it, enhanced sustainability, regulatory compliance. That's a big deal. Fines. If you have a cheap, it's what's the old adage? The quality is remembered long after the price is forgotten. Having a one fine, because a regulatory fine, because you have a low rent organization that's taking care of your waste, wipes out any savings you may have generated and then some. So regulatory compliance data is huge. I just mentioned it a moment ago. It's exponentially the demand for data reporting on waste streams is grown exponentially over the last several years for fairly obvious reasons. And not everybody can supply that. That's something that we can do that really helps out. And the centralization is a big deal. So when you look at some of our clients, manufacturing, industrial is a big part, retail grocers, automotive, fleet, and maintenance, restaurants, and property management has become more of a segment over the last several years, mostly through acquisition. So our platform for the that we use to do that is our national network of vendors that do different things for us. So that's the product that we deploy against the client's needs, and that's how we create our business. So keep going there, Brett. So let's talk a little bit about the vendor network. Adam mentioned at the beginning, we're an asset-light company. We're not a customer-light company. We got a lot of those. From the customer's perspective, they don't know or care whether we own the trucks or not. They care about holding us accountable for the commitments we made, the services that they require, the safety, the savings, the execution. But we do utilize a number of third-party contracted to us third-party vendors that perform the physical services for us. As I mentioned before, we're in every zip code in the U.S. We do have a presence in Canada, and we have over 3,500 vendors that we use to perform these services. We managed over 1.2 million services last year. That's growing pretty significantly as we speak. So there's 1.2 million times trucks stopped, pick up things at a store and hauled it somewhere for us in some former fashion. This is an important bullet here. We leverage vendors' excess capacity. That's really important because these haulers all exist. We don't own them. They have existing capacity. I don't know, say the truck's rolling around and it's 50% utilization, which isn't untypical at all, maybe 75, but it's not 100. And when we're able to bring a national account out to the market, uh, XYZ grocery stores, and we call a hauler that we deal with in that market, and we say, we're picking up XYZ grocery stores. Are you interested in doing that, doing it for us? Well, you're going to, because most likely you're driving by them every day already. And so since you're a local regional, you don't know how to go get a national account. You don't do that. That is what we do. So we're able to bring the benefit and basically be the national account department for local regional hauler service providers. So we represent incremental business to these guys. It's asset utilization and route optimization. So a lot of the times the business we're able to bring to them, the incremental business, is almost all EBITDA for them because they don't have incremental expenses to pick it up. So when we can really enhance that asset utilization and optimize the routes by bringing additional volume to them, the economic impact is huge. So you can guess from that, we're able to command some pretty good concessions relative to pricing, terms, whatever it happens to be. Mostly it's about high quality service levels. So go ahead, Brett. Let's keep going. There you go. Differentiation. We've already kind of touched on a lot of this, but I'll just say this. The main thing that I think you would want to understand or be able to delineate from this is the asset-based integrated majors. That's a big, long phrase, and you know who they are. Those are the large publicly traded waste companies that report, and they own lots of trucks, lots of landfills, lots of processing centers. They're vertically integrated. Another big, huge differentiation is over half of the EBITDA they have comes from landfills versus other services. That's pretty significant since we don't own landfills. We don't let landfills dictate to us how we serve our customers. And so really on a national scale, but limited scope, the limited scope is they're really not interested in a lot of the things we do. Let's just take examples: used motor oil, scrap metal, combustibles, corrosives. So if you're using those big national players as a business owner and you have these other waste streams, you have to find somebody else to do those. So you have multiple suppliers to accomplish the same thing. And we obviously can consolidate and do all that. As an asset light model, it's important to say we're not a slave to capital owned assets. And that's a simple way of putting, I don't own any landfills, don't own used motor oil processor refineries. We can take it wherever. We're agnostic as to the means of disposal is the term. And the reason that's important is we have 100% customer alignment. There's nothing that, as we talk to the customer about how they want their waste streams to behave and what they want from it, we have no economic incentive to do anything but what the customer really wants to achieve. So if we own these assets, it's like to a hammer, everything looks like a nail. If you own landfills, everything looks like that's where it should be because that's your most profitable center. We don't have that. So we think customer alignment is a huge advantageous piece for us. We service high value commercial accounts. We don't have municipalities. So the company picking up your trash in your neighborhood for your city is not that. We don't do that stuff. There's a lot of politics, it's just a mess. We prefer and we will always stick to business. We're able to bring solutions to businesses that don't have emotion make decisions, and we're able to answer their issues. So we have national accounts predominantly. Many of them, especially on the large manufacturing side, we have a couple of accounts that generate 100 different waste streams just themselves. It's beyond comprehension how many of them there are. And we're able to solve that whole problem for them, bring it together, solve it, address it, and simplify it for them. And we can do it in any zip code that they happen to have a location. So a lot of times when a national company wants to do something about their waste, they have to pick people in different regions and have numerous different RFPs or whatever process they go through. With Quest, you don't have to do that. And we can, whatever you want done as a company, we can do it and execute it consistently across all the zip codes. And we mentioned earlier, national scale and scope. With all those services that we provide, the more we grow, the more leverage we bring to the market, and the more attractive we are to our vendor partners. And the reason that's important is the better consistency of execution and pricing that we'll get. And the technology that we're able to use to report back to the customer is extremely unique. The technology in and of itself may not be extremely unique, but the ability to report across all the waste streams and all the locations, so our customer has one report around the waste performance, that is extremely unique. I don't know of anybody else that can do that. So let's keep going, Brett. Okay, so let's talk a little bit about technology. Cloud data portal, this is the stuff that faces the customer. That's really important. So the customer has a portal, as they so choose to do it. We build it for them, we construct it. And it's customized by location, by if you're a customer with different regions and you want it divided that way, we do that. And so it's macro, region, district, individual store, whatever. That's typically how something like that works. And you're able to see all those types of things. And you can see it, it's close to real time. It's not exactly real time, but within a reasonable period, you can see what's happening. We moved everything to the cloud in 2019. We have a centralized ERP system. These are things that I'm sure you would probably expect, but we've utilized that technology to build platforms for our customers to be able to leverage and get that information themselves and put it into whatever format they want. So they have corporate level visibility. That way their volume changes. Trends are what's more important to these customers than the actual tons themselves. They want to see where they are as a baseline. How consistently are they performing? Do they have some outliers relative to locations or regions on performance? And this data will be able to show them all that at a glance. So it's pretty important. Go ahead, Brett. So now it's let's talk about growth. Land and expand strategy drives organic growth. And that's been, I had to pick one thing that this company has done better than anybody consistently since I got here. It's that ability to expand opportunities within existing clients. One of the nice things about having so many waste streams that we have expertise on, it seems like there's always opportunities to expand our spend with existing clients. You know, there's two ways to penetrate or expand, and that's more geography locations or more lines of business, possibly, you know, the existing spend that they have, moving it to our platform. And we have consistently done that. This team has done a fantastic job. Customers, we get them, they grow with us. They give us more geography. They give us more lines of business. And that comes from trust. Companies, especially these larger, successful national companies, they don't expand their relationship with you if you haven't earned it, you know? So that gives me great confidence in the execution of the team that they take care of customers well. But adding both of those to existing customers has consistently been growth for us. And then opportunistically pursue M&A. We have some criteria on M&A as we look at. We don't have a quota. We may go as we have for the last couple of years without buying anything, unless the quote. Basically, the criteria is it's got to move us forward strategically, like bringing additional lines of business, expertise, networks that we don't already have that we can add to our existing platform, or you know, in markets that maybe we don't have a presence in, or we want a stronger presence. Both of those things need to work. And then of course the economics follow from that. And they have to be well run. Typically they're founder operated kind of situations that have outgrown where their comfort level is, frankly. And that's a great time for us to jump in. So when that happens, that happens. When it doesn't, it doesn't. Go ahead, Brett. So I was just speaking to that. So the opportunity is, it's extremely fragmented out there. What's our stat here? 18,000 companies. People think the waste business, I'm sorry, there's an understanding, I guess, that the vast majority of the waste business is concentrated in those 3 to 5 names that you all know. But the fact of the matter is extremely fragmented. There's so many independent companies out there, regional, local, that make up such a large amount. So contrary to popular belief, Waste Management Republic don't control 80% of the market. It's quite the opposite. so that clients are sticky and tend to stay with the acquirer. Basically, when you buy a business and they have clients, when it's those accounts are yours to lose. And the reason why is nobody really wants to change their waste provider unless there's significant reason to do that. So there's an inherent stickiness associated with this in general. We think in business integration, a simple integration process that we have now really helps on the execution and limits the risk. Cost synergies are given, but mostly what we're looking for is synergies and market growth. Cost synergies come through the execution, but we're not buying a company just to create some cost synergies and go from there. We're really looking for it to advance our business and overall. And it's repeatable across acquisitions. Our technology platform has improved and enhanced greatly. So we think that's something that enables us to continue to be successful down the line. Let's keep going, Brad. So in summary, stable, scalable with attractive industry dynamics and financial characteristics. I'll touch on those. Tailwinds. I mentioned earlier that I like the space we're in and we're excited about that. And this is one of the big reasons why. The tailwinds we have between ever increasing costs at landfills. And by the way, if you'll notice, I don't have the exact stats, but every year there's less landfills than there was the year before. Landfills are filling up, and permits to get a new landfill are almost impossible. I mean, it's so difficult to do. So there's a natural, unavoidable drive toward finding more sustainable ways to deal with the waste that our customers and prospects are generating. So again, the increasing costs as well, not just availability. Stable client relationships. These are all of our revenues contracted. We don't have any retail type of or on-demand type outside of our contracted customers. So it's repetitive, it's recurring. It's a need that's not going away. Our client base, as I mentioned earlier, is everywhere, grocery, retail, automotive, restaurant, industrial, construction, and a lot more. We're differentiated with that broad national offering that we've talked about and the diversification of waste streams. And these tremendous clients, we've had, I can't remember the exact stat, but the vast majority have been with us over 7 or 8 years. And it's really a great business. You build strong partnerships with these folks. As with most businesses, we're not selling a service or we're not selling something that like a product that if somebody has the same product for a nickel cheaper, they shift over to that. That's what, in this type of thing, you form partnerships, and shifts are risky and expensive typically. So companies don't like to do that. The scalability of our business model is a huge differentiator. It's one of the main reasons I took this thing, because you can scale, meaning as we're getting to that point now from a technology standpoint, and our scalability is going to continue to increase. I think our EBITDA margins will increase accordingly. We've improved our technology platform to where we can continue to grow and add revenue and have more and more fall to the bottom line. On the margin side, our gross margins more than doubled since 2016. And we've had over 17 million improvement in adjusted EBITDA during that period of time. So the trends are all in our favor. We feel like the tailwinds and the economic environment fits us as well. Brett, go ahead. Yep. Oh, that was a good summary then. So Adam, that's kind of it on the deck.
Excellent. Great presentation. Thank you so much for going through that and for providing all that color. As a reminder to the audience, if you have any questions, you can ask them by clicking the Q&A button at the bottom of the Zoom screen and entering them there. We have a couple of questions trickling in. But I'd love to just start with some of the things you touched on in the presentation. So it sounds like there's a portion of your business that is somewhat collegial in nature, meaning word of mouth and being sort of route dense means you can pick up or win new business. Is that correct? Or can you just talk a little bit about, how you're expanding your business or customer count?
Yeah, one of the 3 legs on the stool is new logos, new customers coming in. You're asking about that, how to get those. We have a group of our salespeople that's all they are, hunters, and they have very deep Rolodexes and industry space. We deploy these guys against a market segment, not geography. So if you're an expert in industrial or automotive or grocery food waste, you have that category across the country, right? So we're going out there with levels of expertise and knowledge of the people collegially. And they've probably done business with them before in some way, form, or capacity. And you combine that with what I feel is a tremendous improvement in our marketing group's ability to help with outreach. The technology today, speaking as an old guy, I can tell you, I'm amazed at the way that we can target decision makers in specific industries and companies with specific messages through the marketing group that's been really soften the ground, if you will, for the salespeople to go out and execute beyond that. So we've really had some nice new logo type of activity recently and a really strong pipeline, Adam, to the future as we go through the balance of this year and into next. And the brand recognition is growing. One of the things we measure, our marketing department measures, is share of voice, which is through a monitoring system across a lot of media versus our competitors, who's being talked about or mentioned the most, and we've really grown in that on the market side, and our salespeople are capitalizing on that.
Excellent. I appreciate that. That's a good transition maybe into an audience question that came through, which is just talking about, can you please talk about what has changed this year in terms of your ability to convert pipeline opportunities? So you've had some success with big wins during the first half of this year.
Mm-hmm.
And the question surrounds, is it because of something specific with the company and your platform? Is it displacing competition or just kind of the right place, right time? And as a follow-up, can you quantify the pipeline today?
Yeah, as with most answers, it's a combination of all the above. We've changed or adjusted our sales structure a little bit, our sales department structure, I'm sorry. I think we've gotten more aggressive. We've brought in some key talent addition to what we already had. And also there's just the fact that there's a long sales cycle here, Adam. I mean, it could be 6 to 18 months on some of these. I mean, it just depends. They're very complex. So we kind of have got a little bit of a culmination all at the same time. I mean, we've had more accounts open this year, new logos come on than we ever have, ever. And I think it's a combination of all those factors above. And again, I think our marketing department has done a great job of helping smooth the way. You know, it's so much easier to get an audience with somebody in a procurement department, a large company, if they've heard of you. Otherwise, you know, you're easy to get be dismissed out of hand if they don't have a reference, for example, or a knowledge or something to see that you've had success somewhere. We even had one come out today, I believe. There's probably about 25 or 30 bylines that we've written in trade publications, you know, to raise awareness on specific matters around waste. All of those things go to create an awareness of Quest and our capabilities, which allow these conversations to get accelerated. So it's hard to put my finger on one thing, but I think it's a combination of a lot of things. These guys are working so hard to do well. As far as quantifying the pipeline, we haven't done that publicly, so we can't really speak to that. But I can give you a relativity that our new chief revenue officer has a definitive number in mind. He wants the pipeline to be X, because of that distinct belief that with executing against that and your close rate is going to end up enhancing revenue. That's the way to approach it. So we have a considerably larger pipeline today, both in revenue and in clients, prospects themselves, than we've had over the last couple of years. And it seems to be accelerating more. So I have a high confidence level that we've already been more successful than we have been in adding new brands. And I think that's just going to accelerate over the next 12 to 18 months.
Excellent. I'm going to throw one more question in there, and then I will pass the mic to Greg for some more Q&A. Just through the lens of competition, you had mentioned sort of your competitive position or how competitors sort of navigate around you guys, and you talked a little bit about regional RFPs. Mm-hmm. And I would love if you could maybe just speak broadly or specifically about what you were referring to there, and maybe dig a little bit more into sort of your competitive position or how people compete against you.
Yeah, it's a challenge, because this is going to sound arrogant, I guess, but I think it's a challenge to compete with Quest on a broad-based basis just because of the capabilities. I mean, there's nobody else out there. It depends on, as a customer, what your needs are. typically as a customer, you're going out to find somebody to get you better pricing on your solid waste. That's how it starts. But then you have so many other type of waste streams that are being dealt with. It's not part of your RFP or your need that you're expressing. Our salespeople have the ability to go in and talk to them about what, but you have a fleet too, don't you? And they said, well, yeah, of course. Well, we do fleet maintenance and UMO and used motor oil, and we can solve that problem for you. And you're generating scrap metal in your plant over here. Well, yeah, well, we do that too. So the differentiation comes from our ability to typically nobody calls you asking for all of those things because they would just be calling us because nobody else does it. And then our sales team has the ability to take it out of a standard RFP process on a very narrow segment and expand it with the much better values we're able to bring across the platform. So what typically a lot of times will start as an RFP ends up being not an RFP, and we're able to bring a broader based solution than they anticipated initially. So that's kind of, but the RFPs are pretty predominant. But there's two ways. There's a lot of companies that say, well, we don't respond to RFPs because they're too cheap. I think that's foolish. RFPs mean there's opportunity. Uh, a customer is expressing a need, an opportunity, and a desire, frankly, to consider alternatives, whatever they're doing today. That's an open door for us to go in and really talk about Quest and why we're different and how we can enhance their as a company through the services. But they're regional, national. They come from all different directions. But that's on that side. I just view RFPs as another opportunity to shove into our opportunities to go talk to somebody about what we do well. Those are the easiest sales, frankly. The hardest ones when you got to convince somebody they need to do something different. If they've already believed they got to do something different, you've kind of won half the battle there.
Excellent. Great. Well, yeah, Greg, please feel free to chime in. We'll get some more Q&A and then we'll go back to the audience questions if we have time. Thanks.
Absolutely. Thank you, Adam. Ray, I think when I think about the business, you joined in 2016, like you said, and I think there's kind of been 3 chapters of your tenure so far. The first was kind of course correcting the business that you inherited after you joined. And then chapter 2, that was like maybe through 2020, and then you started to grow organically, and you demonstrated the ability to grow organically and make some targeted acquisitions. And now I think chapter 3 kind of is starting now-ish, where you demonstrate consistent, profitable growth and operating leverage. Mm-hmm. And I think one of the things that makes me so excited about this current chapter are some of the investments you've made in the business over the last 2 to 3 years. And the biggest one I think has an impact on your ability to win business is I call it your internal business intelligence investments, but it encompasses zero touch, it encompasses vendor sourcing and some of the other things that you've talked about. Ultimately, those investments should lower your cost to serve your customers, and that gives you an opportunity to make more gross profit dollars and EBITDA dollars. And so you can either keep it or invest it to grow faster, or some of both. How do you think about what you're going to do with those savings?
It's definitely both. I mean, it's the player that can operate more efficiently in any competitive space has a competitive advantage. But I will tell you that enhancing EBITDA margins and growing gross profit with our profitability, with our existing revenue is great, and we're focused on that. But I'm probably most excited about the fact that we get to be even more differentiated when we go to the market, and at a certain price point, we can make money and somebody else can't. As we drive this efficiency, and then once we get a customer through that process, the ability to expand and grow and enhance margin. That's another thing I didn't mention earlier, Greg, is that when we get a new customer on, that's usually in most industries and companies, whatever margin you get a customer on, that's it for life, right? I mean, that's what it is. In our case, these guys can add so much gross margin from leverage on the cost side. As we have a client, as a client matures with us, its profitability typically grows, and that's really kind of unique to our space. Typically that's not the case because we're constantly working on leveraging the cost side and enhancing our gross margin that way with these clients. But yeah, I'd like Greg can speak to or not Greg. I'm sorry, Brett can speak to a little more detail on the internal investment on the efficiencies.
Sure.
Yeah.
I can jump in. Yeah. I mean, Greg mentioned the zero touch. I think that's probably our largest near-term opportunity. We kicked that off at the beginning of this year, and it's really about uh, driving a zero touch initiative on our payables process, being able to ingest vendor bills and pass them through our processes, through our systems seamlessly and with automation so that we never have to truly touch an invoice that, and it requires a lot of discipline. So one, it requires investment in automation, which has been key. But two, it also requires a lot of discipline on the management, the quality of the data on the front end of our systems to be able to match up vendor invoices all the way down to the line level, not just at the total invoice level, but really doing a true full end line to line audit for our customers is a really powerful value add in and of itself. But it also allows us to get data to them more quickly. It allows us to process more efficiently and build that true scale, and allows us, even for on the vendor side, right, able to process more efficiently, reduce errors when we're making those payments as well. So really, you know, it's an investment across our vendors, our customers, and internal efficiencies that's really exciting. And just as a base point, when we kicked off this initiative, our baseline for zero touch was zero. We touched every single thing, and especially a system like that is fraught with errors. So when you have an exception, you have multiple touches to remedy those exceptions. And ultimately, we're targeting near term 80 to 90% zero touch, and already a long way there. Vendors are, all of our solid waste vendors are now on our platform as of August 1. Still have a little few kinks to work out, but really excited about the progress we've made there.
Good.
Thanks. That was really helpful. And I think what's important to understand is, I think previously, before zero touch, like you said, you were touching every single invoice. And so you were touching those with people, and that was, full-time employees. And so going forward, as you continue to scale with your customers, what that sounds like to me is that you'll be able to hire fewer employees as you continue to win business, because you can onboard those customers with zero touch, so that's an automated process. And so you should be able to scale much more easily than you have in the past.
Yeah, absolutely, Greg. And it's about the discipline on getting that data right on the front end as you're onboarding. And once that data is correct, then it should be seamless. I mean, to that point, we just onboarded a new customer in August, and we saw one of those first-time vendor for us with this new customer. And it wasn't a huge amount of invoices or lines that we got through this vendor, but it was a great example of first time with this client, first time with this vendor, new data, got the invoices, they came through 100% matched on our platform and got pushed to pay without us ever having to touch. So that's the goal and the vision of what we're trying to build out. And we've already seen where, we can do that at 100% zero touch. So really exciting.
That was great. Thanks, Brett. And Ray, just to touch on your part of that answer, land with a new customer, and then you can grow and enhance that relationship over time. I think on the Q2 call, you talked about a 7-figure revenue expansion with a customer that you won in Q1. And so just evidencing what you said, once you get in the door, there are a lot of opportunities to expand.
Yes, very much so.
The second part of the investments that I think about are the team. I think 5 years ago is when the chairman, Dan Friedberg, joined, and then you brought in, Perry Moss as the CRO, and Stephen Koskary and Dave Schweitzer, you've worked with for a long time, Jim Bentley, Will Reynolds, a lot of other people, and then obviously Brett joined. And so maybe can you just talk about the team and where you think it is today, and what investments you're looking at continuing to make?
Yeah, that's my favorite topic, Greg. Thanks for that softball, because we got some great folks. I couldn't be more proud of them, and they're from varied backgrounds. I worked with Dave Schweitzer, our COO, years ago, previous company. He's the operator's operator. I mean, he's if you drew a picture of an operator, that would look a lot like Dave. Perry, our CRO, is actually kind of an icon in this space on the sales and marketing side. He's been around forever, and he's tremendous relationships, tremendous success track record in building largely, in a quick way, large way companies. Brett, of course, came to us when Lori retired. He's been a great addition for almost 2 years now. Time flies. And I want to talk about Will a little bit. Will is somebody from the outside of the business also. Brilliant guy. I hope he's not listening, so he won't get a big head, but Will's a brilliant guy. He's a processes guy. He's a systems and process. He's not an IT guy. He'll be quick to tell you IT reports to him. Will is basically his job now. We're changing his title to SVP of Business Transformation, and he's driving a lot of these automation aspects and new processes and finding new and better ways to do what we already do, which is nothing but enhancing our ability to grow and grow more profitably. Steven's been with us for a few years, a great sales guy. I don't want to miss anybody. We have a number of others. So when I sit around every Friday on our staff meeting, Greg, and I see all the faces, I pinch myself about the talent that we have in this team. It's truly got the capabilities to be a much larger company with the talent I already have today.
Thanks, Ray. Adam, did you want to ask one, or I have many more?
Yeah, thanks. We probably have time for one or two more questions, or maybe
Great.
maybe two or three. So please feel free to continue. That's fine.
Okay, great. Just maybe I'll make sure to touch your balance sheet. In early 2022, you were nearly 5 times levered on a trailing basis, and you've grown the business so that you're about 3.5 times levered on 24, and expecting to further delever next year. Can you talk about your plans to refinance your debt and your focus on reducing debt?
Yeah.
Take that, Brett.
Assume I'll take that one.
Yeah.
Yeah. So Greg, to that, in March, the end of Q1, we did do an extension on a refinancing. We still had another year, but looking at kind of the landscape of the lending environment at the time, and also knowing the growth that we anticipated coming into this year, and into next year as well, felt like we were going to be in a much better position to command better pricing just from our increased size. And we're hopeful that the lending environment would be more favorable for us. Both of those so far have proven to be, justified, and I think we made the right decision. So we did extend, and we're working through evaluating some advisors to kind of help us with that, but certainly expect a refinancing that can meet our 2 primary goals going into this, which was maintain some flexibility. To your point, we certainly want to delever as aggressively as we can, absent any other incremental investments that make sense. But we have been aggressive. Last year, we did $7 million in voluntary payments to that term loan. So that speaks to, the aggressiveness of trying to pay down and delever where we're at. And then the second goal was to get even better rates than where we are today. So that's, like I was saying, that's proven out as well. We certainly feel like we're going to be able to reduce our rates going forward in the environment.
Thank you, Brett. On your external data and reporting, you talked about what you're providing to customers. I think about it as an example, Ray, you often say it helps you identify the question to ask. For a grocer, they can audit food spoilage between 2 stores. They can say, is this store's refrigerator freezer not running correctly? and that's why we have more spoilage, or are we perhaps under inventoried at a different store? Can you talk about how your data helps you win more business?
Oh yeah, it's such a distinct advantage, Greg. We call it waste performance, which that sounds like a oxymoron, but it's really companies need to see what their waste performance is because it affects their bottom line. It's such an indicator. The example you just used is pretty prevalent. When you look across a number of locations and you see something that should be the same, give or take a few percentage points, and it's distinctly different, it makes you as an operator, as a customer, wonder why, right? And then there's any number of things that should be fixed, and none of them is waste information, but waste information is what gave you the operator. It really makes me happy to see waste information turn into operational information. So waste information up until the last decade, I guess, was basically the bill you got each month, from your trash provider. You owe $587 for this store for this month, and that's it. And so you get no operational insight from those type of things. But the detail we give now, every waste stream, how much of it, when was it picked up, where to go, and then the trends tell you a lot about the performance of whatever your entity is, a manufacturing plant or a store. So I love it for a lot of reasons. One is for bringing more value, but two, it makes us pretty irreplaceable. Is the more dependent you become on that data and your operation, the less you can operate without Quest, frankly. So we see it as a real advantage, one, in gaining clients because of that capability, two, in retention because of that dependence that's created.
Thank you, Ray. I think we have time for one last one. So I want to touch on competition. You had two private competitors that got acquired by private equity last year for what I think were mid-teen EBITDA multiples. And private equity isn't necessarily known for making aggressive investments in sales and marketing. So there might be some opportunities there. And you have a public competitor that is suffering from an overly levered balance sheet. What changes, if any, do you see in your competitive set that are causing you to say, hey, right now is a good time to invest more in our sales team?
Well, the valuations that have been created by our friends at private equity is, I'm frustrated when I'm buying, and I'm happy from a valuation perspective for us. I can't imagine how much we're really worth then, based on some of the numbers that Brett and I've seen being paid out there. The competitor you're talking about that's heavily levered, it just gives us more and more incentive to be better at what we do, and the market sees that there's a different. It's not just the space we're in that makes you good. It's the execution. Quest and this team I talked about has executed so well. We're in the same space as that other company, but yet these guys are able to drive improvement and discipline and quality results. The others. So I guess what I'm saying is that it encouraged me to make more and to grow better, faster from an investment perspective, because the market is valuing what we do. And so in that perspective, it makes a lot of sense to be aggressive in our growth.
Excellent.
Thank you.
That's a great place to wrap it up. Thank you so much, Greg. This has been great. I really enjoyed the presentation. Thank you for all the color on your business. Thank you for taking the questions from our attendees. We had a really strong attendee base today, so whatever you're doing seems to be garnering the attention of our community. So keep up the great work. And thank you again very much, Ray, Brett, Greg, David. Really appreciate it. Thanks so much for the opportunity to talk about the company. We love doing it. Appreciate it. And thanks to everybody that tuned in to listen as well. Great. Have a great rest of your day. Thanks again. Bye-bye.